There are about 10 pieces of conventional wisdom in personal finance that get repeated so often most people stop questioning them. You need $1 million to retire. Wait until 70 to claim Social Security. Pay off the mortgage before you retire. Each one has a kernel of truth, an audience it works for, and a much larger audience that loses real money following it. The median household at 65 in 2026 has nowhere near $1 million, and most of them are doing fine. Break-even age for claiming Social Security at 70 versus 67 is around 82, which means about half of people will not live to break even on the deferral. Whether you should pay off a mortgage depends almost entirely on what rate the mortgage carries, a fact most retirement advice does not pause to ask about. Today I'm going to walk through 10 of these rules, the 2026 math that contradicts each one, and what to actually do instead. This is not a rant, it's a math correction. I'm Tom. This channel is about real personal finance for normal people. The kind that actually works instead of the kind that sells you a course. No motivational fluff, no fantasy returns, just what the math actually does over time. If that's what you're here for, hit subscribe. Today, 10 rules that show up in every retirement article since 1995. The specific 2026 data that contradicts each. And the version of each rule that's actually defensible once you stop and run the numbers. Rule 1. You need $1 million to retire. This number gets quoted by financial planners, repeated in headlines, and treated as the bar that separates secure retirees from struggling ones. The math says otherwise. Median net worth for households headed by someone 65 to 74 is around $410,000 per the Federal Reserve's most recent survey of consumer finances, including home equity. Median household income for that age group in 2024 was $56,680 per the census. That's less than half the $1 million number, and the people living on those numbers are not, in fact, all destitute. Most of them are managing acceptably because the actual math of retirement income is not just savings divided by years. The average Social Security benefit in 2026 is $24,852 per year for a single retired worker, or roughly $40,000 for a couple where both worked. A paid-off house removes the largest single expense from most household budgets. Add a 4% withdrawal on a $400,000 portfolio and you have $16,000 a year of portfolio income. On top of Social Security combined, that's around $41,000 of annual income for a single retiree, or about $56,000 for a couple, with a paid-off house and a stable mix of fixed and discretionary spending. That's a median retirement, not a destitute one. The math actually requires you to calculate what you specifically need to spend in your specific situation, and backsolve from there. A frugal household in a low-cost area with a paid-off house and Social Security needs $400,000. The higher spending household in a high-cost area might need $2.5 million. $1 million is somebody else's number. Rule 2. Wait until 70 to claim Social Security. Conventional wisdom says always defer Social Security to 70 to maximize lifetime benefits. The math on this depends on 3 things: your expected lifespan, your marital status, and the rest of your income picture. Here's how it works. Claiming at 62 pays 70% of your full retirement age benefit. At full retirement age, currently 67, you get 100%. Claiming at 70 pays 124%. Thanks to the 8% annual delayed retirement credit you earn between 67 and 70. The math of waiting from 67 to 70 is straightforward. You give up 3 years of benefits in exchange for a 24% higher monthly check for life. The break-even point, where the higher checks make up for the missed early ones, is approximately age 82. The Social Security Administration's actuarial tables for 2026 show life expectancy at 62 of about 20 more years for men and 22.5 for women. That means the average male making this decision will live to about 82, almost exactly at the break-even. The average woman, 85, comfortably past, but these are averages. About half of men deciding at 62 will not live to 82, and they lose money by deferring. The decision depends on factors the conventional wisdom skips. If you're married, deferring locks in a higher survivor benefit for your spouse, which often tilts the math toward deferring even if your personal break-even feels close. Known health issues or family history of early mortality argue for claiming earlier to preserve more lifetime value. A pension that covers your expenses and lets Social Security be supplemental gives you more flexibility on timing. Wait until 70 is the right rule for some people. It is the wrong rule for many others. Calculate your own break-even, run it against your actual health expectations, and decide. Rule 3. Pay off the mortgage before you retire. This rule sounds disciplined and feels safe. The math depends almost entirely on a single number. The rule never asks about what is the interest rate on the mortgage. If your mortgage is the 3% rate that millions of Americans locked in during 2020 and 21, the math points strongly toward keeping it. 3% borrowing cost against an expected real return of around 7% on equities is a 4-point positive spread. On a $300,000 remaining balance, that's roughly $12,000 a year of opportunity cost if you accelerate the payoff with funds that could otherwise stay invested. Over the remaining 10 years of a mortgage, you're potentially leaving over $100,000 on the table. If your mortgage carries the rates closer to current 2026 levels, where the Freddie Mac average is 6.5%, the math gets closer. 6.5% borrowing cost against 7% expected returns leaves a half-point spread, which gets eaten up by sequence risk and tax inefficiency. At those rates, paying off the mortgage becomes more defensible. But most retirees today are not paying current rates. They're carrying mortgages from when rates were 2 to 4%, and the rule that says to pay them off ignores the rate environment they actually live in. The other consideration the rule misses is liquidity. Equity locked in a paid-off house is not accessible without selling or borrowing against it. A 70-year-old who paid off their mortgage with cash that could have stayed liquid has lost optionality at exactly the life stage when optionality matters most. The honest version of the rule: compare your specific mortgage rate to your expected real return on investments. If the spread favors keeping the mortgage by more than 2 points, keep the mortgage. If it doesn't, consider paying it down. The decision is rate specific, not values specific. Rule 4. The 4% rule guarantees you won't run out of money. The 4% rule, originally derived from Bill Bengen's 1994 study of historical market data, says you can withdraw 4% of your initial portfolio in year 1 of retirement. Adjust that dollar amount upward by inflation each subsequent year, and maintain a high probability of not running out of money over a 30-year retirement. It's a useful guideline. It is not a guarantee. 3 things the rule does not factor in matter more than people realize. Sequence of returns risk comes first. The rule was tested across multiple historical periods, including some bad ones, and the 4% threshold barely survived the worst cases. Retire into a 15% market drawdown in your first year, and the math gets much tighter even if you stick to the formula. Second, the rule assumes a 30-year retirement. Retire at 60 and live to 92. And that's a 32-year horizon that the 4% number does not hold as cleanly across. Third, the rule doesn't account for the early retirement healthcare cliff that comes with retiring before Medicare at 65, where ACA subsidy structures and pre-Medicare insurance costs can substantially affect spending in the first 5 years. Research from Wade Pfau and others suggests that given lower expected real returns going forward, a sustainable withdrawal rate closer to 3 or 3.5% may be more defensible, particularly for retirees with longer horizons. Other approaches use guardrails, spend a bit more in good market years, cut back in bad years, and adjust dynamically rather than mechanically. The framing you usually see is some version placed for most retirees. It is not a ceiling, not a floor, and not a guarantee. Use it as a sanity check, not as a permission slip to ignore the actual market environment you retire into. Rule 5. You need 80% of your pre-retirement income. This number is everywhere. It comes from the rough idea that you stop paying FICA, your taxes drop, and your work-related expenses disappear. So 80% gets you close to your current standard of living. The actual data does not support 80% for most people. The BLS Consumer Expenditure Survey for 2024, released in December of last year, shows average household spending peaks in the 45 to 54 age bracket at roughly $100,000 per year and drops to about $61,000 for households aged 65 and older. That's a 61% replacement of peak spending in actual practice, not 80. The drops come from predictable categories: Mortgage payments disappear for the more than half of older households that own their homes outright. Work-related expenses go to zero, which for many professionals includes commuting, professional clothing, workday food, continuing education, and the various adjacent costs of holding down a job. FICA taxes of 7.5% of payroll disappear because you are no longer drawing payroll. Income tax brackets typically drop because Social Security is only partially taxable and your IRA withdrawals can be sized to fit specific brackets. The 80% number is not actively harmful, but it sets a higher savings target than most people actually need. Told you need to replace 80% of $100,000 pre-retirement income. You're planning for $80,000 a year in retirement? The data says 60 to 75 is more realistic for most. That's a $10,000 to $20,000 a year overshoot in your planning, which translates into needing to accumulate $250,000 to $500,000 more in your portfolio than you actually require. The honest replacement number is between 60 and 75% for most households. Plug your own numbers in. Rule 6. Move to a no-tax state to save money in retirement. Conventional wisdom says relocate to Florida, Texas, Nevada, or one of the other 6 states with no income tax to save money in retirement. The math is more nuanced than the rule suggests. State income tax savings scale with your taxable income. A retiree pulling $300,000 of pension and IRA withdrawals from California saves about $20,000 a year by relocating to Texas or Florida, since California's brackets climb above 9% at higher incomes. A retiree with $60,000 of income, which is closer to the median retiree, saves more like $2,000 a year in state income tax. The savings scale with income, and for most median retirees, those savings are smaller than the rule implies. The other side of the equation is what the no-tax states charge instead. Texas has property tax averaging about 1/4% of home value, well above the national average of around 1%. A Texas homeowner with a $400,000 house pays around $5,600 a year in property taxes versus around $4,000 in a typical state. Sales tax in Tennessee runs 9.5%, in Washington 9.5%, in Nevada around 8%. Florida is genuinely retiree-friendly with the homestead exemption and the Save Our Homes assessment cap. But rising housing and insurance costs are eroding the advantage. The deeper issue is that many states with income taxes do not actually tax retirement income. Pennsylvania, Mississippi, Illinois, and several others exempt Social Security, pension, and IRA distributions entirely. A retiree in Pennsylvania might be paying less total state tax than a retiree in Texas, depending on the mix. Run the total tax burden math, not just the income tax number. For most median income retirees, the move is roughly a wash. For high-income retirees with mostly portfolio income, the savings can be real, but they should still be weighed against moving costs, distance from family, and what the new state actually offers. Rule 7. Stocks are too risky for retirees. Conventional wisdom says shift heavily to bonds at retirement to reduce risk. The actual risk in a 30-year retirement is not market volatility. It's inflation slowly eating your purchasing power while you watch. Inflation has averaged around 2 to 3% per year historically, which means cost of living roughly doubles over 30 years. A retiree with a 100% bond portfolio earning around 4% nominal yield gets roughly 1 to 2% real return after inflation. On a typical retirement portfolio drawing down for living expenses, that real return is not enough to maintain purchasing power across a 30-year retirement. The portfolio runs out, usually in the early to mid-80s for someone who retired at 65. A 60-40 portfolio with equity earning around 7% real and bonds earning around 2% real returns roughly 5% real blended. That's enough to sustain a 4% withdrawal across 30 years while keeping pace with inflation. The difference between heavy bond and balance is not just volatility, it's whether your money keeps up with what your money buys. The risk people are actually worried about, large drawdowns at the wrong moment, is real and is the subject of sequence of returns research I've covered in other videos. Sequence risk is not solved by going to zero equity. The answer is calibrated equity, often in the 60-40 to 50-50 range for someone in their late 60s and 70s, paired with a cash buffer of 2 to 3 years of expenses to ride out bad years without selling stocks at the bottom. Stocks are not too risky for retirees. Bonds in isolation are too risky for retirees because they don't keep up with the cost of being a retiree. Rule 8. You need long-term care insurance. Long-term care insurance is the rule that gets sold by people who profit from selling it, and the industry behind it has spent the last decade quietly breaking down. Here are the numbers. Genworth Financial, one of the largest long-term care insurers, raised premiums on more than 2,000 policyholders in 2022 by an average of 97%. Increases range from 79% to 173%. In 2025, Genworth's average premium increase across all approved actions was 38%. The same company stopped selling new individual long-term care policies in 2019 and now operates the existing book as a closed system. Several other major carriers, including John Hancock, MetLife, and Transamerica, have either exited the new policy market or imposed similar repeated premium increases. A Connecticut review of state insurance records found that from January 2019 through October 2024, more than 17,000 policyholders receive rate increases of 50% or more. The industry's problem is structural. They sold policies decades ago at premium levels that turned out to be too low for the claims they're paying. They are now raising premiums on policyholders, often elderly, who have already paid for decades and cannot easily walk away without forfeiting everything they put in. Genworth's CEO compensation has been tied to obtaining further rate increases, which is documented in their own SEC filings. The alternative is self-insurance. Build a long-term care fund of $200,000 to $400,000 over your working career. Hold it in tax-advantaged accounts where possible and let it compound. Most people will use a fraction of it for actual long-term care. The rest passes to heirs. For most middle-income retirees, the math beats paying premiums into a system that may raise rates 97% on you when you can least afford it. Some hybrid life insurance and LTC products offer more transparency than legacy standalone policies. They're worth a look if the insurance route still appeals, but the default assumption that everyone needs LTC insurance is wrong, and the math behind the alternative is often stronger than the marketing suggests. Rule 9. Just buy index funds and let them grow. Low-cost broad market index funds in your tax-advantage accounts are the right default for most investors. The rule that fails is the assumption that index funds plus time equals optimal outcome, with nothing else to think about. Asset location is what index fund-only advice usually misses. I covered this in detail in my 400K rules video, but briefly, the same index fund in a traditional 401k, a Roth IRA, and a taxable brokerage account has very different after-tax characteristics. Bonds and high dividend assets in a taxable account get hit with ordinary income tax every year on their yields. Growth stocks in a traditional account eventually pay ordinary income tax on all their growth at withdrawal, while the same stocks in a Roth pay zero forever, above $400,000 of total assets. This location decision produces somewhere between 0.5% and a full percent of additional annual drag if you get it wrong. Over 20 years, real money. Rebalancing is the other thing the rule misses. A target date fund handles this automatically. A self-managed portfolio of index funds drifts over time, often toward more equity than the original allocation, often right before a market correction that the original allocation was designed to weather. The rule also misses the decumulation phase entirely. Drawing down a portfolio of index funds in retirement is not just the inverse of accumulation. It involves coordinated withdrawals across account types to manage tax brackets, planning for required minimum distributions, and adjusting allocations as your time horizon shortens. Index funds are the right answer. They are not the whole answer. Set it and forget it works for accumulation under $400,000. Above that, it leaves money on the table that paying attention costs nothing to recover. Rule 10. It's too late to catch up if you're behind at 50. This is the rule that does the most damage, because it discourages people who could still build meaningful retirement security from trying. The math says it is wrong by a lot. A 50-year-old with $250,000 saved, 15 years from retirement at 65, can max the 401k catch-up of $32,500 per year. At 7% real return, those contributions alone compound to roughly $816,000 by 65, on top of whatever the existing $250,000 grows to. That existing balance, untouched, doubles to about $689,000 over 15 years at 7%. Combined, the late starter ends up at $1.5 million at 65 from a starting position of $250,000 at age 50. The catch-up window is the most underused provision in the U.S. tax code. $8,000 a year added to the standard 401k limit between 50 and the end of your working life. $11,250 in the SECUR 2.0 Super Catch-up window for 4 specific years between 60 and 63. $1,100 added to the IRA limit at 50. $1,000 HSA catch-up at 55. Use all of them, and the annual tax advantage capacity at 55 with family HSA coverage reaches roughly $50,850, almost 25% higher than the limit before 50. The reason this rule keeps getting repeated is that it sounds humble. It sounds like accepting reality. What it actually is permission to give up at the exact moment the tax code is offering you the largest advantages it ever will. The math for someone 50 with $250,000 saved is not bleak. It is the most concentrated wealth building period the US system makes available. And most people walk past it because someone told them they should have started earlier. You should have started earlier. You didn't. Run the math now. 10 rules. Some made sense 30 years ago, some still apply in narrow circumstances. None of them is the universal law that the conventional repetition makes them out to be. The pattern that connects all of them is that the rule was written by someone who didn't know your specific situation, didn't run your specific math, and isn't going to be in your kitchen when the consequences show up. What the rules want you to do is hand over the decision to a generalization. What the math wants you to do is run your own numbers in your own situation with current 2026 data and decide for yourself. The math doesn't care what the rule says. The math only cares about your actual inputs. Run your own math. The rulebook is a starting point, not the ending. If this helped, hit subscribe. I'll see you in the next one.